All right, this video is going to focus on monetary policy. And monetary policy is when the government and parts of the government use their power over controlling the money supply, like the actual supply of currency in this country, to deal with any kind of like financial problems that might be going on like during the time period. So, unlike when we talked about fiscal policy, where that's really a shared responsibility between the president and Congress, monetary policy is really more established by a group called the Federal Reserve. So, the Federal Reserve is a group of people that sort of run the main sort of like regulatory agency for like your bank. So think of this as like the bank for your banks. It's basically led by a board of governors, which basically serve 14-year terms. They're appointed by the president and confirmed by the Senate. And the Federal Reserve is led by a chairperson, also appointed by the president, who serves a 4-year term. So these individuals are largely responsible, right? They work out of Washington, D.C., for establishing the country's monetary policy. So you got to think about like what bank you have your money in. Is it like TD Bank? Is it like Wells Fargo? Is it another bank? Think about what you do at your bank, right? You're basically using it as a storage place for money. The Fed is the bank for your bank, and right now you're just probably using it as a storage place for money, birthday money, or you have a part time job. You're just using it as a place where like your money is being housed. Later on in your life, you might have to use your bank for other things, such as like getting a loan if you're going to like use like money for big purchases. So there's a couple things that the Fed can do that deals with like monetary policy that relates to your access to perhaps get loans from your bank. The first thing the Fed can do, the first tool it has in its toolbox, is it can manipulate what's called the reserve requirement. So again, the Fed is the bank that regulates what your bank is able to do. And if they change the reserve requirement, they're basically changing the amount of money that your bank has to have on hand at all times in their vaults, right? So, let's say the Federal Reserve is trying to fight against a time period in the United States of inflation. So, like, what tools does the Fed have, right, related to the reserve requirement to fight against inflation? So, one of the things the Fed can do is raise the reserve requirement. Basically, what this means is that your bank is being told by the Fed that they have to keep more money back. So, they're able or not able to give out as much in the form of loans. So, when the Fed tells your bank you have to keep more back, that's going to like reduce their ability to give loans to citizens. And if loans can't get like given to citizens, the citizens don't have access to the loans, this will probably reduce like spending, right? Because you're not going to be able to buy whatever you wanted to buy that you needed the loan for. So this is a tool that the Fed can use basically to try and reduce spending, is to raise your bank's reserve requirement. On the flip side, if there's a period of deflation where the Fed is trying to encourage spending, one of the things they can do is lower the reserve requirement. This basically means that your bank is able to have less on hand, which basically means they can give out more in the form of loans. And if citizens have greater access to loans, this may encourage like spending. So one of the tools the Fed has is the ability to raise the reserve requirement. And depending on how like what they do with it, it may either increase or decrease the amount of loans that are being given out, and that may increase or decrease spending. All right. The second major thing that banks do, right, is related to this, right, is when they give out loans, you need to know what interest rate the bank is giving you a loan at. So, an interest rate determines like you're always paying back what you borrow, but the interest rate determines how much you pay back in addition to that. Right? Banks are not in the business of just giving you free money. So when you borrow $10,000, you have to pay them back $10,000, but the interest rate determines how much you pay beyond that. So, quick example: think to yourself, you need to borrow $375,000 from the bank, right, to buy a new home. What do you think is a fair amount that a financial institution should charge you for the right to borrow $375,000? Like, you're paying back the 375, but like, what do you think is fair to pay back the bank beyond the 375 for the ability to borrow that? So just to show you examples of why the interest rate is important. So let's say you want to buy a home at $425,000. You have $50,000 that you're willing to put towards the purchase price that you have in savings. So that basically means you have to take out a loan for $375,000. Home loans are typically 30 years. And let's say about 10 years ago, the interest rate of the loan was 3.79%. So, based on these financial figures, this is how your payments would work out. You're borrowing $375,000 to the bank. You would basically be paying back $253,000 in interest for a grand total of $628,000. So you're paying back the 375, but for the right to borrow the 375 at that interest rate, you're having to pay back $253,000 over that 30 years. That basically breaks down to about a monthly payment of $2,100 a month for 30 years, right? Some like big numbers. But right now, the interest rate is higher. It's 7.8%. So, same numbers that we're using. We're taking out a loan for $375,000, but now the interest rate is almost double, right? So, now look at the difference. The loan amount is $375,000, but the interest being paid back is like $597,000, which means now your grand total of your loan is $972,000, and now you're paying about $1,000 more a month over the course of 30 years. Look how a raise in the interest rate dramatically changes how much more you have to pay back. So think about that as we go through the next thing. This last tool that we're going to look at that the Fed has basically to deal with problems in the economy is manipulating what's called the discount rate. The discount rate is the rate at which your local bank borrows money from the Fed. So you borrow money from TD or Wells Fargo, and they're borrowing money essentially from the Fed. So the rate at which your bank is borrowing money from the Fed is going to determine what interest rate they're charging you. So the discount rate is the rate at which your local bank borrows from the Fed. The interest rate is then the rate at which you borrow money from your local bank, right? Hopefully that makes sense. So again, there's a period of inflation, right? People are spending, 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 spending. So what tools does the Fed have basically to throw the brakes on consumer spending? One of the things they can do is raise the rate at which your local bank is borrowing money from them. This means it's going to be more expensive for your local bank to borrow money. Okay. So what is the impact that that has on you? Well, your bank's not going to lose money. So if it's costing them more money to borrow from the Fed, they're going to have to charge you more money to borrow from them to make up the difference. So an increase in the discount rate is going to lead to a raise in the interest rates that your local bank is going to give to you. And now all of a sudden you saw when the interest rate goes up, you have to pay so much more back. So maybe now, because it's going to be more expensive for you to borrow from your bank, you're going to wait to get that loan. You don't need the new car, you don't need the boat, you don't need the addition on the house or a new house. You're going to wait till the interest rates go back down. So what the Fed can do to reduce spending is raise the discount rate, which is going to force your bank to raise the interest rate, which is going to make it more expensive for you to pay back loans. So maybe you'll just wait. But on the flip side, again, if people aren't spending and the Fed is looking to like invigorate the economy, how can they do that? They can lower the discount rate, which means it's cheaper for your bank to borrow from them. You get the benefit of that. That basically means that they can offer you, your bank, a lower interest rate loan, which now all of a sudden maybe is the thing that you've been waiting for to go spend that extra money when you take out that loan. So if the interest rates go down, now maybe you've been waiting and you see the interest rate go down. So now you know it's going to be cheaper for you to take out a loan. You're not going to have to pay as much back beyond what you borrow. So now is the time. Like you're going to take out the loan, you're going to buy the boat, you're going to buy the sports car, you're going to get the addition on your house, whatever the case may be, right? So this is going to encourage spending, which would be good during a time period of deflation, right? So these are just two tools, right? The reserve requirement and the discount rate that the Fed has at its disposal, basically to deal with economic problems that may be going on. And this is in addition to the fiscal policy stuff that Congress and the president might be doing.